both like institutions or retail would want to use blockchains for this? Like, what's the blockchain advantage to lending?
It's very rare that people pick up and use a new product just because the technology is really cool. That's like if you look at the kind of the hype cycle, that's like the super early adopters. That's not kind of the bulk of the market. The bulk of the market picks it up when you can kind of offer something they can't get elsewhere that's like better, faster, or cheaper. So if you look, traditional firms won't lend you stablecoins. Like if you're a crypto native firm and you want to go and trade on a centralized exchange, you're actually better off just getting stablecoins rather than getting fiat. There's also a distinct lack of supply of lending against crypto coming from traditional finance. A lack of other options is kind of also driving people, towards solutions like us.
All right, here we are with Sid Powell, founder and CEO of Maple Finance. Sid, it's great to have you back on the Defiant podcast.
Thanks for having me back, Camila. It's been a while.
Yeah, and lots has happened. So great to catch up, especially because real world assets, on-chain lending has been, I think, one of the strongest areas in DeFi and crypto, maybe a little bit overlooked, but I think kind of where the real where the real use cases are happening, and it's in the name, real world assets. So
I agree. I think after stablecoins, I think real world assets and indeed yield products on chain are kind of one of the areas that's seeing the most kind of growth and also the most interest from traditional finance players, because they all instinctively get it. A lot of them come from banking backgrounds, and so they instinctively get the idea of credit or fixed income on chain. And it is alongside like derivatives and things like hyperliquid. It's one of the few areas that's kind of producing cash flows for projects.
And
at this stage.
We'll get into the details on kind of the growth we've seen on that front. But I want to take a step back and just start from the very basics for those who might not know what Maple Finance is and does, to provide just bit of context. Maple Finance is one of the biggest real world assets protocols out there, driving I think it's the third largest on-chain lender for
in terms of assets outstanding. So just to put some kind of numbers to give listeners at home context. So we have around 800 million in assets on the platform, or in TVL. And so you can think of us like tokenized private credit. Private credit is one of the fastest growing segments in traditional finance. And effectively, we're tokenizing loans to private companies. Our clientele happens to be crypto native institutions who serve as borrowers. But it really, like, that 800 mil mark puts us kind of at the upper end of RWA focused protocols on chain. But all of that, that's effectively loans and collateral. And we, have a loan book of hundreds of millions of dollars to institutional borrowers out there.
So I'd love to hear a bit of the story on how you got there, and then we can talk about kind of moving forward, kind of the trends you're seeing, because you've had you've been around DeFi for a while now, and you had some really spectacular growth recently, starting from mid last year. So I'd love to hear kind of the journey.
Yeah, for sure. Happy to. And so maybe to kind of start from the beginning. So Maple's been around operating since 2020. So that was late 2020 was when we raised capital. So really like very early last cycle. And our focus has kind of always been credit and lending on chain. And really the kind of the pivotal inflection point for us in this most recent cycle was late 2023. We launched over collateralized lending, and that's now formed the basis of that 800 mil TVL that we have today. And on that kind of 18-month journey, we've seen a couple of critical inflection points. Q2 last year, what we did was we widened the collateral that we would accept, and we started doing loans over collateralized against Solana and other large caps. And at Solana, backed lending really propelled our growth through Q2. And then Q3, we made the decision to launch Syrup USDC, which is our permissionless product. So what we wanted to do was we wanted to be able to partner with, protocols out there. So like Pendle, Spark / Sky, and Morpho. And what we needed a kind of permissionless access point for those players who are DeFi protocols themselves to come in and access the product. Under the hood, it's all still the same institutional over-collateralized loans. But it gave us an access point for these partnerships. And then the second point was retail access. So the core product had been restricted to accredited investors, whereas by having a retail product, we could take a client from Argentina or from, Japan, let's say, as long as they had USDC and wanted yield. And that pool, Syrup USDC, that's now the largest one on the platform at almost 300 mil TVL by itself. But it now has integrations with Pendle. So there's a PT and a YT pool where folks can lock in a fixed yield. They can use it if you're depositing. You can actually use it as collateral on Morpho. And we've seen a number of hedge funds start to do looping there because the Syrup USDC token or LP token pays a higher interest rate than the borrowing cost on Morpho. So we've seen, DeFi hedge funds look to do that looping. And then most recently, we actually got onboarded by Sky and Spark. And so they're now deploying some of their balance sheet into the Syrup pool. So really that was a tremendous inflection point for us over the last 18 months was getting that out and those integrations.
Very cool. So the first integration, integrating different kinds of collateral for over-collateralized loans, this is all still for private credit. So like when you mentioned Solana, these are institutions who are lending their Solana assets, and then institutions on the other side who are borrowing that out, or how does that market work?
It's a good question. So our borrowers are all institutions. So this can include OTC desks, prime brokers. We actually have a couple of centralized exchange borrowers, and hedge funds like on-chain hedge funds. I think folks who might do yield strategies, whether it's Pendle or Athena or something similar. And then the newest type of client we've had has been high net worths and family offices. We had one high net worth client who wanted to borrow against their ETH to buy, purchase some large real estate as an investment. So, but the borrower side is all institutions. And in the case of that Solana, it was the institution pledged us their Solana as collateral, or their SOL as collateral, and then we lent them USDC. And on the other side, that USDC will come from a mix of high net worths, corporate treasuries. Some corporate treasuries like the idea of lending against Bitcoin or ETH, for example. And then, professional asset managers as well. And then through Syrup USDC, we have more of your kind of like DeFi retail or protocol users.
Okay, so
it is very varied.
Interesting. Okay, so now with your retail product, you're also supplying stablecoins for institutions who are looking to borrow stablecoins against their different crypto.
That's right. Yeah. The biggest demand we see is always still borrowing stablecoins. We've tried lending altcoins or other large caps. The most significant type of deal we did was we lent Solana for that locked FTX estate deal. So in that case, a couple of institutions wanted to borrow SOL so they could forward sell it to hedge the price from the locked deal. But by and large, all the demand we see today is pretty much for stablecoin borrowing. And that continues to grow. I'd say the market's been a little bit quiet around the tariffs and the macroeconomic uncertainty. So we have seen rates compress a little bit there to kind of the mid to high single digits. But that can flip like that. Like in December, we were seeing rates, 12% and higher. So it is very macro driven, but because the space is so small that the supply and demand can kind of change very quickly, and that will drive significant changes in rates. But I would say at the moment, kind of less appetite from borrowers, but because Bitcoin's not ripping, we're seeing a lot more demand for yield. Folks are sitting there, they're saying Bitcoin's not going back to 100K in the next couple of months. So I'm going to sit in stables and try and get the stables to work for me and earn some yield. And that's when they come to us.
And the difference with other lending protocols, say, Aave, or the yield here is coming from, the difference is like, I guess, the users of their protocol, right? Like these are institutions who are borrowing, and that's where you would get the yield if you want to lend your stablecoins.
Yeah, that's exactly right. I would say Aave and Spark now has kind of a mix of different yield sources. But Aave, for example, the borrowers are probably skew a little bit more like retail or DeFi whales. So they're very comfortable with smart contracts housing their collateral. Whereas for our clientele, often they might be sitting on native BTC. And so if you look at like an institutional borrower who, let's say they're an asset manager, they don't want to wrap their BTC. They view that as like a taxable event, or their accountants do. So it's going to cost them taxes. And then they typically won't be comfortable with smart contract risk for their collateral. So if you look at our model, we send out all of the loans on chain. So they're all done through smart contracts. But the collateral, we actually are integrated with custodians and with institutional wallets like Fireblocks or Porto. So you can give us native BTC as collateral, and then we'll send you a USDC loan through our smart contracts. But you're not actually taking smart contract risk on your collateral, and you don't have to wrap it. And so we find that those institutions will typically pay a little bit more to work with us because they just prefer those mechanisms. And from a compliance perspective, they're more comfortable with the counterparty risk. And the other element I'd say is we don't do automatic 100% liquidations. So if you're an institution borrowing from us, you're not going to find that if there's a wick on, a wick in the price of Bitcoin or ETH, you're going to get 100% liquidated. We send you a margin call. You have 12 hours to post. And then it's only if the price continues to drop or if you don't respond to that margin call that we would liquidate you at that point. So no people are not going to get fired for that. Whereas if they put the money in a smart contract and they get liquidated overnight, it's much harder for them to justify.
It's really interesting. You're combining
a hybrid.
Yeah, you're like a hybrid kind of DeFi, CeFi, custodial, non-custodial protocol. And it seems like this is what institutions are comfortable doing at this point. Can you talk more about kind of, how institutions are using DeFi? Are they getting more comfortable? Like the transition that you've seen kind of in the years doing this, what types of users you're seeing now versus, what you had seen before? Kind of how has that evolution been on institutional interest in using DeFi, even if this kind of is like a hybrid DeFi protocol?
Yeah, I think it's a good question, and I can give a little bit of wider color as well as to like what other protocols institutions are using. So market makers have always been kind of very forward in DeFi. Like our original borrowers back in 2021 and 2022, market makers were quite comfortable taking out loans from DeFi. What I would say has changed is that, more and more institutions are now comfortable either integrating with DeFi or connecting their clients with DeFi. So if you look, I think the most interesting recent use case is probably Coinbase linking up with Morpho and allowing their customers to wrap BTC and CBBTC and then deploy it into a smart contract and borrow from a Morpho pool. So I'd say that kind of, yes, Coinbase is already a Web3 native institution, but it did indicate a degree of appetite that we just hadn't seen back in 2022 or 2023 for that matter. And the other thing I would say is, last year you saw folks like Cantor announce that they were interested in BTC-backed lending, and indeed a couple of other, credit funds or credit asset managers kind of, hinted that they might provide BTC-backed lending products. So I think that indicates, again, kind of more general comfort with the space. I would say where there's holdups at the moment is I don't think any of those players will be connecting with smart contracts. That's still like very difficult for them from a compliance perspective. They're just worried about hacks or security risk, particularly following things like the Bybit hack. But they are comfortable lending against crypto collateral and with the general concept of crypto-backed lending and DeFi lending. So I think that's where we have seen real advances over the last couple of years. And the other point I would make is I talk with a number of market makers and trading firms now, and a lot of them are trading like hyperliquid perps and some of these other perps dexes. So I'd say that's also something that just wasn't there, going back 2 or 3 years.
Goat Network is the first sustainable BTC yield chain, powered by decentralized sequencers using multi-coin POS. Goat's mission is to transform BTC and Doge from passive holdings into active, yield-generating assets through a one-of-a-kind economic model that tokenizes sequencer revenues, unlocking the full potential of BTCFi and MemeFi in a way that's never been done before, and creating new yield opportunities for Bitcoin and Dogecoin holders. Supply BTC or Doge, earn BTC in perpetuity. Get started through our user rewards onboarding portal, onepiece.goat.network.
And when we say institutions, like what exactly are you referring to? Is it like hedge funds? You mentioned family offices, like what exactly?
In this instance, I'm talking about regulated asset managers. I think family offices have always been early adopters, and they're almost like family offices as a category really blend very closely with high net worths, and they're typically early adopters. I think what we're not seeing is it's not banks. I would say there are two kind of restricted in terms of regulatory controls as to what they can do, and they've only just come out of policy gridlock with things like SAB 121. But what we're talking about here is like think regulated professional asset managers and like regulated trading firms. So Cantor is a good example of a firm that said they have appetite for BTC backed lending. Bitwise, regulated $12 billion asset manager. They have the BTC ETF, among other ETFs, but they made a deployment that they were able to announce about a month back. And so they're another example. Professional asset manager, but looking at on-chain deployments and indeed starting to get comfortable with that because they kind of view that this is the future of asset management, is that it will go on chain. And then the other ones, there's large market makers out there, whether it's like Hudson River, Tower, Jump, Jane Street, and others. And some of these players, not necessarily one of those named ones, but some of these players are trading on on like hyperliquid perps. And so that's an example of high frequency trading firms who are generally very sophisticated using some of these on-chain products.
Super interesting. And again, in the case of lending, the use cases, these asset managers are holding Bitcoin, and so they're looking for ways to get more yield out of that Bitcoin. Is that basically, they're instead of
it might be a couple of things. So if you're a prime broker, often they have a long bias position in BTC, so they want to hold it. They might have accumulated unrealized gains, and they don't want to have a capital gains event that they have to pay tax on. But they hold it because they can post it as collateral on different exchange venues, and so some of these players they will post us Bitcoin so that they can remain long Bitcoin, take dollars, and then provide that as margin to their clients. So generally what they need is like, they're not asset poor, they're actually quite asset wealthy, but they're just cash poor. And so what they need to do is generate stablecoin balances from their BTC or their SOL or their ETH holdings. And in some cases, like family offices, it might be that they want to make a long-term investment, and so they come to us to get a fixed rate, fixed term loan. and that they can put into real estate and not worry about the interest rate fluctuating, 10% in volatile periods. And then trading firms, so a liquid token firm might have a position that they have high conviction in. Let's say it's Sol or MKR or Sky or Aave. They might want to post it to us so they can borrow more dollars and then buy more of that position. Their alternative is using futures or perps for that type of thing, but that can be expensive, and then you have a risk of liquidation on those assets. Whereas here it can be, working with us can be a good strategy if you, one, don't want to pay as much in the way of funding cost, or two, don't want to worry about short-term liquidation risk. And then the other type of firm would be an on-chain yield fund. So they might be doing looping strategy through Morpho or on Pendle, and they want to borrow from us to put dollars into that yield strategy because it pays them more than what the cost of borrowing from us is. So I know that was like a few different use cases, but kind of it is kind of varied.
Yeah, you mentioned kind of the one of the last holdups is from banks. Or at least those are like the big institutions that are not playing with DeFi. Do you think that the fact that with regulations just changing and banks are now able to custody crypto and there obviously the regulatory environment is a lot friendlier and yeah, you see kind of the repeal of these bills that made it impossible for banks to deal with crypto. Now, that's gone. So do you see that changing soon? Or is it still, too far from what banks do to kind of start playing with DeFi? Or do you think kind of with the regulations that have just changed, is that enough? Or would you still kind of see more changes needed down the line?
More changes being needed? It's a good question, and I think my gut feel is that it is going to be a number of years before we see banks kind of doing much more in the space. That being said, I know a couple of community banks that are looking at lending against Bitcoin. So though if they were to successfully do that and get the charters for it, then I think they would be very early adopters. But I think one of the issues that banks will struggle with is that they have to hold risk capital, right, which is set by Basel Committee, and then adopted in every jurisdiction around the world. And so to lend, the interest rate and the collateral that they're required to take depends on how the asset is treated under those risk capital requirements. And so that's like turning the Titanic. You have Basel 3, you've got to get to Basel 4. They have to determine, how risky loans against Bitcoin are. And I think banks might be able to get into the space through partnering with people like us who could securitize those assets. And that allows them to consider them kind of like high quality liquid assets, which gets them better risk treatment. But I think them doing it directly, it's going to be a very tough kind of string to draw. But I am kind of concerned with them as competitors because I can't compete with a JP Morgan's cost of capital. So how we have to think about it is we have to kind of remain nimble, onboard clients quickly, provide, quick service and turnaround, and, offer kind of bespoke terms. But I see our competitors as being folks like Ares and Apollo. It's private credit asset managers, because that's really the space that crypto-backed lending is growing into. It's kind of like a very small initial wedge that will grow to kind of be more and more of private credit. And then firms like us, it's kind of this innovator's dilemma thing. We're starting with a market they consider, trash and unattractive. But if you can sustainably grow that, then we gradually move up market, and they find that they're going to struggle to compete on speed and cost.
Why was this sector considered trash?
Well, by them, I remember reading in one of the Ares commentary, as one of the Ares quarterly insight reports at the end of 2022, they were kind of like sort of dancing on the grave of crypto post FTX and saying, Bitcoin is not good collateral, and that, only a fool would consider lending against crypto as an asset class. I think, it's a, $1 trillion, Bitcoin itself is $1 trillion plus asset class, and crypto itself is more than $1 trillion asset class. It's no different to lending against a stock, in my view. If you look, there are a number of stocks that trade on the NASDAQ that have negative earnings, but you would still advance a margin loan against them. Bitcoin trades over 50 billion a day, 24/7. I can liquidate at 2 a.m. on a Sunday if I want. And so I think they got that wrong about the asset class, but they accredit people, so they're naturally paid to be skeptical. But I think, it's classic sort of innovator's dilemma. None of them are disrupting themselves. I think the closest to doing sort of this stuff and the furthest along is definitely Apollo, where they're actually tokenizing some of their funds. But none of these guys are doing loans against crypto at the moment. And I think they're missing out on an attractive market. And, it's kind of our job to sort of grow that and try and take the lead there.
Okay. And so for you, you are worried or working to move fast and lead that market before they get in.
Yeah, exactly. I mean, if you think about it, if you just did a kind of assessment of the market, let's say that there is $1 trillion of Bitcoin, and more if you count the other asset classes. But I think that is an eminently attractive asset class, loans against Bitcoin, for institutional investors like insurance companies, pension funds, endowments to hold as a highly liquid credit investment or fixed income allocation. It's short duration. You can get your money back in less than 30 days. It's over collateralized with an asset that trades around the world 24/7, and it pays better than, it pays like a yield commensurate with investment grade or high yield bonds, but without the duration and kind of less of the counterparty risk because of how much reliance you can place on the collateral. So I think the idea of tokenizing that, and you can have you can create, similar to what you did with like the residential mortgage-backed securities market, you can create a standardized formula where it's like 70% LTV loan against Bitcoin, open term, Bitcoin is held in qualified custody, and you could sell billions of dollars of that to institutional investors as like a money market plus type fixed income instrument. So I think that the addressable market is tens, if not hundreds of billions of this stuff as we move forward.
Because right now, I think the tokenized funds that have gained most tractions are the like treasury bill funds, right? But these like structured products are really interesting. How big is that market? Like, I'm not sure if you're already doing it and if like that's taking off, or kind of what's the status?
Well, I think structured products will pick up. I think the reason that the tokenized T-bill stuff is not picked up is that you can pick up the phone and call Morgan Stanley and get a pretty good substitute for that product. Same with a lot of the tokenized equities and tokenized bonds and tokenized funds, other credit fund structures. And so who are you selling to? I don't think the marginal buyer is on-chain saying, hey, I really need to get that BlackRock fund, or I need to get that Hamilton Lane fund. I think most of those buyers are off-chain in traditional finance. What's a better selling point is, hey, you can't call Morgan Stanley and get this product. You can't call Morgan Stanley and get a basket of loans backed by Bitcoin or the yield from those loans. And that's effectively what we're packaging and selling to allocators. They lend to us and we put their funds into those types of loans. And I think if we can create an insto wrapper for that can be easily consumed, I think they will buy that because they can't buy it from competitors. I think you always have to kind of go where you have a differentiated edge.
PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
And then, sorry, Cami, there was a second part to that question.
No, just I was just asking on kind of the like what the market for like these structured products look
how
like.
big is it?
Yeah.
Well, I think structured products do tend hundreds of billions a year. We've tried a structured product this year where we had a yield product where you got a 4% floor, and then if Bitcoin ripped, you could get up to 33% by using a call spread on top of the over collateralized loans. So it was similar to a structured note. We got about a bit under 10 mil of interest in that. So I think that's still nascent, and that kind of product space needs to evolve. But on the BTC backed loans, like how big could that get, and how big could general crypto backed loans get? Well, even if you said only 10% of Bitcoin, let's say 10% of Bitcoin could be borrowed against, or holders have appetite to borrow, that's 100 billion. And then if you can do 70% LTV loans against that, that's $70 billion of lending that you could do. If you contrast that, I would say the space at the moment, excluding DeFi, is probably less than, it's less than 5 billion in terms of crypto-backed loans outstanding. And if you include DeFi and other sovereigns who might be borrowing, then I think you get to like closer to 10 bill, but that's still a fraction of what we're talking about in terms of total addressable opportunity. 2022, the crypto lending market was 55 bill. So we're still less than 20% of what we were, 3 years ago in size.
Oh, that's interesting that we still, I thought we were already
haven't caught up.
least...
And the leverage in the system is much lower than it was back in 2022.
Why do you think that is? I mean, I know like the market has been volatile this year, but we had a decent kind of bull phase recently. Yeah, why do you think that DeFi and kind of the lending space hasn't been able to overtake like the previous highs?
I think the market structure has shifted. And so if you look at participants who were active in the last cycle, so BlockFi, Genesis, Celsius, the role that they played in the market structure was to act kind of similar to banks. And what I mean by that is that they provided a velocity for stablecoins and for other assets to kind of move around the DeFi ecosystem. So you're a retail consumer, you put your money with Celsius. Celsius can lend it out over collateralized or under collateralized to somebody. It could be like a fund or institutional borrower. They then use it to purchase tokens, or they invest in a project, and then it becomes a treasury deposit or treasury savings. But it worked. What I think was happening was that it was working its way through the crypto economy, and so you're having a multiplicative effect. Let's just say consumer deposits with BlockFi. BlockFi lends to Alameda or FTX, and then FTX uses that to then, place more money or purchase collateral that they post to Genesis or to a Voyager or somebody else. But the system was much more interconnected back then. And so a dollar was actually being counted more than once around the system. And because you had those companies, so BlockFi, Celsius, acting as aggregators for retail deposits who were then originating credit, the degree of leverage in the system could get much higher because those retail depositors wouldn't, other things equal, they're not in the system today making uncollateralized loans, whereas when their deposits went to a Celsius could then make an uncollateralized loan using that deposit, and that created just much more leverage within the system. Right. And so the market structure has totally changed today. We don't have those retail aggregators, and we don't have anyone originating uncollateralized credit in size today.
That's so interesting. You're right. So, yeah, all the CeFi lenders obviously, collapsed or went bust. Yeah, they were in many cases, tied to Alameda, and in other cases, like Celsius, not kind of disclosing exactly what they were doing with loans, like taking too much risk. Yeah,
like Celsius could have, Celsius in some cases was taking a deposit and then putting it in a DeFi protocol.
Yeah.
Like they had significant holdings of like wrapped staked ETH. They were significant participants in some of the Uniswap and other LP pools. So that money was working its way from their deposit base back into the DeFi ecosystem. And then it was being used for, DeFi yields, launching new protocols, providing liquidity to other protocols. But the velocity of money was just much faster then. And also they had, similar to how banks have today, like banks have a lot of overnight repo deposits with each other. Some of these larger lenders had overnight repo type facilities with each other. And so money was very interconnected between them.
So interesting, right? So we don't have that CeFi lenders bridge to DeFi anymore. And
no, if you look
right.
at the largest CeFi lenders today, so you have Ledin, Galaxy, Coinbase are some of the larger ones doing it, but you can check their financial reports, right? So Galaxy and Coinbase are in the order of like, call it 400 to 700 or 400 to 800 million in terms of loan book. Whereas you contrast that at its height, Celsius was 26 billion. So these are vastly different scales of lending operations that are going on today. We will grow because I think, lending is an integral part of any kind of, financial ecosystem. But, the space was so, shocked after 2022 that it's taken a long time to get back there. And, we're among one of the larger ones with kind of 800 million assets on the platform and close to 300 million in loans outstanding. But even we are still like a kind of a fraction of what those institutions were last cycle. But I think it will grow over time.
Where do you think growth is going to come from?
Has to come from new entrants to the space. So the key drivers, stablecoin issuance. Like most of us are lending predominantly in stablecoins. And so we need more stablecoin. As more stablecoins get minted, that supply has to go somewhere. And so it either goes to centralized exchanges, or people keep it on their private wallets, or they put it in DeFi, or they can give it to lending businesses like us, or like a Ledin or an Arch or some of these others. And so that would be a big driver of growth. And I think, but the other thing is, if we can't count on retail coming back in, you have to count on institutions. And so I look at some of these big traditional finance balance sheets who have expressed interest in crypto-backed lending, whether it's Cantor or, some private credit asset managers. And they, when they come in size. And so I think that's going to be another key to scaling. And then the other thing I think is, if we get a market structure bill, asset managers will be more comfortable kind of, interacting with on-chain asset management products like we are trying to be.
Can you talk more broadly about why both institutions or retail would want to use blockchains for this? What's the blockchain advantage to lending?
It's very rare that people pick up and use a new product just because the technology is really cool. That's like if you look at the kind of the hype cycle, that's like the super early adopters. That's not kind of the bulk of the market. The bulk of the market picks it up when you can kind of offer something they can't get elsewhere, or that's like better, faster, or cheaper. So if you look, traditional firms won't lend you stablecoins. So I think if you want to go, if you're a crypto native firm and you want to go and trade on a centralized exchange, you're actually better off just getting stablecoins rather than getting fiat. There's also a distinct lack of supply of lending against crypto coming from traditional finance. So I think just a lack of other options is kind of also driving people, towards solutions like us. But how does it scale? Well, for us, if you're a trading firm in Japan and you've got some Bitcoin and you want to borrow, well, if you want to borrow a US dollar facility, there's nobody else who can provide you this. You have to borrow stable coins. It's going to take you forever to access a US dollar facility through some other means in fiat. And so the fact that we can settle with that firm, within an hour if we wanted, and we could do that at 2 a.m. on a Sunday, really we can settle 24/7 and settle with clients in other countries. I think that reach of stablecoins is very persuasive. And same for allocators and investors. If you want to access our yield product, you can just connect to the app, you onboard, and then you can deposit straight away through your wallet. You don't have to go through a multi-day process to try and wire us funds. And so we can offer lower costs because of that, because we're able to move faster and reach clients, kind of anywhere in the world.
Right. Eventually, do you think that...
Oh, sorry, one more thing. Yeah. I think the liquidity over time, the fact that you can tokenize these and then shift your positions by just as easily as shifting tokens, I think is going to be really persuasive for sophisticated asset managers who particularly if they have to manage large portfolios, the fact that they could take a lending position, use it as collateral somewhere, or that they can easily shift it or sell it on the OTC market, I think is going to count for a lot over time.
like you would think that having access to products that you can't get in TradFi, like stablecoin loans or borrowing against crypto, and 24/7 liquidity, and just like faster and cheaper transactions. What will that result in? Like, do you see all of lending moving on chain, or is it going to be like it just like more of like a crypto native economy? Like maybe we'll see more asset managers that are focused on crypto with managing treasuries of crypto startups, and just like a crypto native economy that's already emerging, that's going to become bigger, and that will be the majority of kind of where we see this market going? Or do you see more of like we will have this crypto native market, but the like non-crypto natives will also move on chain?
It's a good question. I think I'm very bullish on the space. My answer is I think all of this moves on chain over time, and the question is just what time horizon does that look like? I think 5 years is probably too soon, but I think the progress that we make between 5 years and 10 years is going to surprise a lot of people. And so, I'd be surprised in 10 years if you're not settling a lot of, like if a lot of, conventional financial and capital markets activity is not being settled using stablecoins. I mean, even just thinking like the convention from TradFi, right, of T+2, well, stablecoins, it's it's T0. It's instant. I've kind of seen this firsthand. Like I come from Australia, and so, I wanted to send some money back to my brother the other day. And so I was asking, well, can you just give me a USDC, an address, and I'll send you USDC? And he was like, no, I need fiat in a bank account. Okay, well then I've got to like off-ramp money. I've got to type in a routing code, a Swift code, and then it's going to take, and then I'm going to get, cheated on the Forex fees, and it's going to take 3 days to reach him. Like it's just a much better experience of like, hey, text me your wallet address and I'll send you USDC. So now imagine that at scale in business when there's an opportunity cost of foregone revenues by having to wait 3 days for that money. And you can see, just like the rise of high frequency trading firms, the amount of usage and transacting that can occur when you can settle instantly and anywhere in the world is going to dramatically increase. I think it's like Jefferson's law or something, but as the cost and speed of something evolves, like the usage exponentially grows.
Get up to 20% APY on ETH with the High Growth Vault by Kelp in one click. High Gain uses blue chip DeFi strategies with RS ETH across Aave, Pendle, Usual, and Elixir, managed by strategy pros Ultra Yield and Upshift to deliver highest rewards on ETH, all in just one click. Deposit your ETH, receive HG ETH, and stay liquid in DeFi. Trade or use HG ETH on platforms like Pendle and Balancer while still stacking rewards. Follow along these steps to get started.
Let's talk about your more specific to Maple products. So we talked about how you have this new kind of retail focused product, Syrup. I also know that your token Maple is also now being swapped to Syrup. I don't know, if you can talk about kind of all that side? Kind of transition.
Syrup USDC is the permissionless yield product that we have. So that's available to retail users outside of the US, but also protocols that want to use us. So, Pendle's in there, Morpho has integrated us as collateral, and folks are using it in their looping strategies. And then Maker, or Sky, I should say, also recently made a deposit this week to that product. So that's yield coming from institutional loans. Permissionless token moves around DeFi. Late last year, we migrated our governance token. And this is the governance token for the network. And I think an important thing to note about it is Maple doesn't have an equity entity that kind of sits behind things. it's just the token. So the token controls the network. The single token that we have is Syrup, which we migrated to from MPL last year. And we did that because the DAO treasury needed to raise more funding, and so it needed to issue more tokens after 2023. Nobody plans to go through a bear market when you initially set a fixed supply of tokens, but to continue building the network, we needed to issue more tokens, and so that's why we migrated to Syrup. Syrup's the sole token that kind of ties together all of our products. So Maple, our institutional strategies, Syrup USDC, the permissionless one, and indeed now our Bitcoin yield product. If you stake it, you can participate in voting. And we've actually also done a buyback, so of 20% of protocol fees. And protocol fees at the moment are between, call it like 5 to 6 million kind of annualized. And so the community voted to spend 20% of what we earn in a quarter buying back the token as a kind of an example of utility and rewarding folks for staking and participating in governance. I think that's going to be really interesting this year because you've got a lot of L1s and L2s that are kind of zombie chains now that don't have a lot of usage and aren't generating real revenues. So I think a lot of folks will look to kind of turn on protocol fees and have buybacks for their token. And for us, it's kind of it all goes towards the staking yields, which is currently about 3.7% if you're staking the token.
Interesting. And is the only or like main use case of the Syrup token governance?
Yeah, it's primarily governance. Some of the interesting things we've looked at is like whether you could get discounted fees, so you'd be able to earn a higher yield if you're staking, or whether it could give you access to some insurance protection against defaults. I think the protocol needs to get bigger before those use cases start to become feasible, but we're kind of always thinking about how utility can be added to the token, but primarily it's governance for the time being.
Got it. And I guess that's just an interesting takeaway from your experience with the token. As a founder or like people building in DeFi, if the token is kind of your main asset, then it's good to have that flexibility to be able to issue down the line, to be able to raise with the token down the line.
Yeah, I think so. I think that the token helps incentivize staff. It helps with fundraising. It also helps with partnerships and customer acquisition. So you can do points programs. And I think, that's something that's kind of interesting and only available, for token projects. AWS wasn't giving out ownership of AWS, the network, when they started, nor was Facebook, but it would have been interesting if they could have done that for early users. And Uber tried doing that for some of their early drivers, but they were blocked because it's just too cumbersome when you have a private equity, whereas it becomes possible when you have a token network. So I think that's a really interesting way to kind of bootstrap businesses and networks. And then you can also do, like partnership deals. So if you're partnering with another protocol, you can do a token swap. So I think it gives you a lot of versatility. It's not without its downside because the token can fluctuate wildly with the vicissitudes of the market, and so that can be kind of a cause of distraction for a lot of teams. You can have issues where teams and founders and things are kind of dumping their token on the market, as we've recently seen with a couple of launches, and I think that creates a lot of bad blood or bad energy around teams, and it's kind of like it's a temptation of greed, right? But I think our token's been around for over 4 years, and I think we've always tried to be transparent. We put out quarterly treasury reports as to how we're spending, how funds are being spent. Most of the token's circulating, so it's not like one of those 10 to 15% low float projects that's trying to that's trying to impact the FDV. Most of the token circulating, it's been around for 4 years, and then the team still holds a hefty proportion of the token, and our interests are aligned because there is not an equity entity collecting all of the revenues. It's it's really treated as being for the benefit of token holders.
It's really interesting. This decision of not having an equity entity. Yeah, like what was your thinking around that, and like how? Yeah, I don't know. Like how do you structure your business that way? Because like I think like most DeFi protocols have like the like equity company, like a labs or something, and then like the foundation that runs the protocol. But like having no like centralized equity company is like a, I don't know, especially with like a hybrid DeFi protocol.
We have and maybe just to kind of to clarify and kind of frame that, we have LLCs that we use for kind of operations. You need to, like, you can't enter contracts with people without people in other businesses without LLCs. We have a Cayman foundation that's kind of like the top of everything, and that's really, it's a memberless foundation that's kind of acting for the benefit of token holders in its charter. But what we didn't do is we never raised equity into an entity and sold that to venture funds. They always just participated by purchasing the token, and we're able to do that because we came through in 2020, and so there was a big emphasis around DAO raises at the time. So we kind of just treated that as the initial way that the network raised funding to begin operations. Whereas now, I think if you're doing it, you probably have a tougher time doing that. But I think it also creates issues, right? Like, you saw in 2022 or 2023, DYDX was earning a lot of fee revenue, and was that going to labs or was that going to DYDX token holders? And there was a big spat about it with some liquid funds that held the token. Whereas here, there is no conflict.
Yeah, no, I think that's a good point to consider for people.
Yeah, founders should consider it. Like your cap structure is important, and also the distribution and the ownership of the network is important.
We talked about all these Bitcoin products, and you recently mentioned a partnership with Core. Would love to hear more about that.
Yeah, so one of the products that we've been super excited about that we recently launched in the last 2 months was a Bitcoin yield product. And for us, this is being done in partnership with CoreDAO. So they're proof of stake Bitcoin L2 and or L1, I should say. But either way, the product we're offering with them is you provide Bitcoin, we stake it, dual stake it with the Core governance token, and this generates rewards that are converted into Bitcoin yield for holders. So what it looks like to a lender who's using it or a customer of ours is they put in Bitcoin and they get back Bitcoin yield that's liquid, and it comes from staking. So there's very little counterparty risk. We're not out there lending it out, and I think the other aspects of this that are interesting is that there's no slashing risk on your staked Bitcoin, and you can do it through a custodian. So the Bitcoin we take ultimately sits in BitGo and Copper at the moment. So it's sitting in these qualified custodians, rather than being deposited into a smart contract where it could be exploited. So I think those angles make this a very appealing product for institutions. And I think this product overall, it's been yielding in the kind of the 4 to 6% range, annualized, which is kind of, it's pretty far ahead of what you can get elsewhere. But the other aspect of the product that's interesting is that all institutions, when they come to the crypto space, are going straight to Bitcoin. So whenever I talk to the folks covering institutions at Coinbase or Galaxy or others, their new clients are looking to go straight to buying Bitcoin. And the natural next step for them is, can I borrow against this Bitcoin? And that's our lending product. Or could I get a yield on the Bitcoin since it's sitting there in this custodian? I think that's where, this is a great product to have and to be able to offer them. And despite the fact that Bitcoin's been around now for 15 years, we're still so early in the degree of penetration that it has as an asset class. And So I see this product as being extremely interesting for institutions, and we have a good partnership with Core. So that product's grown to about 60 mil in TVL in the first 2 months, and we continue to see pretty strong institutional interest in it.
Wow, that's so interesting. And yeah, it makes sense that, institutions own Bitcoin first. And so, yeah, they'll want kind of Bitcoin related products. But yeah, they
and it's a diversified thing you can offer them when the market's kind of flat.
Mm-hmm.
Yeah. So anyway, I think we're very bullish on Bitcoin structured products and Bitcoin yield products for the rest of this year.
Yeah, it's been interesting to see Bitcoin DeFi take off or develop.
Real resurgence.
Mm-hmm.
Yeah. 100%. And you can see this year there's half a dozen new Bitcoin L2s or L1s that are coming to market, whether it's Babylon, Lombard, Build on Bitcoin. There's about half a dozen, and it's interesting. They're all kind of converging at the same time.
Yeah. Okay, and then to wrap up, what's coming up for Maple? Like, what are the next milestones that you're excited about that you're working on?
Well, I think that for us, the biggest one is getting that TVL to the billions. So we want to continue to kind of cross the all-time highs from last cycle, and so we're looking at kind of 3 of the key things we're working on. On the Bitcoin side, we want to get a liquid staking token out. So that's the big focus for the next 2 months, and that will allow trading firms to post it as collateral, use it in DeFi. So we see a lot of application there. On the Syrup side, we're trying to get that more. We want to get Syrup across on Solana, so Syrup USDC. So we're very bullish on kind of what I would say is like an emerging yield system there. There's been a lot of trading, but there hasn't previously been a big focus on yield in the ecosystem there. So we want to get across there. We think very highly of the ecosystem. And then on the Insto side, we are talking with a number of TradFi players around getting what I would call a wholesale facility so that we can grow the business. So that's kind of like the number one focus in each of those 3 categories. But it's just a lot to execute on this year. But our TVL goal for end of the year is 4 billion TVL. So we need to hit all 3 of those initiatives to do that.
Awesome. Well, yeah, they all sound really exciting, and we'll definitely be watching and covering at the Defiant, and hopefully, end of the year we'll have you on again, talk about how you reached that 4 billion.
Would love that. Gives me a lot to shoot for now.
Amazing. Awesome. Sid,
Well, thanks for having me on,
Cami.
No, you're welcome. Thanks for having me.